Welcome to the deep dive. So if you've been keeping an eye on the crypto market, you've probably heard all about Bitcoin's wild price swings, maybe the latest NFT craze or some new app. But today, we're going to pull back the curtain a bit. We're looking at the actual financial engine, the hidden machinery that really drives most of the action. We are going deep into this, well, sort of hidden world of perpetual futures. Highly leveraged, incredibly active.
Yeah, that's a really key point to make right off the bat. For most people, crypto is like buying Bitcoin, holding it, seeing the price go up or down, spot prices. But for the pros, or even, serious traders, their whole world revolves around these perpetual futures, or perps as they call them. And this isn't some small corner of the market. We're talking about a battle for control over infrastructure that handles, what, $1 trillion a year in volume? Something like 75% of all crypto trading volume flows through perps. If you really want to understand how wealth is made and lost in crypto, how the markets actually move, you absolutely have to understand perps.
Okay, right. So let's unpack this then. Here's the mission for today's deep dive. We're going to nail down exactly what perpetual futures are. We'll make sure everyone listening, even if you've never heard the term, gets why they're so powerful. Then we'll look at the big players, the established giants, the centralized exchanges, the CEXs, and then introduce the challengers, the decentralized insurgent platforms like dYdX, GMX, and especially the newer rivals, Hyperliquid and Aster. We'll really dig into that Hyperliquid versus Aster fight because it's kind of defining the future right now. And crucially, we'll look at how one absolutely massive global flash crash basically proved, under extreme pressure, which system, centralized or decentralized, is actually built to last. All right, let's start right at the beginning, because perpetual future, it sounds pretty technical, maybe a bit intimidating if you're not deep in finance. So for someone listening who hasn't dealt with this, how do we define a perp and what makes it different from, say, a traditional futures contract you might hear about for oil or corn?
Yeah, good place to start. Think about traditional finance first. If you buy a futures contract for, let's say, crude oil, you're basically signing an agreement. It's a legal contract to buy or sell that oil at a set price on a specific future date. That's the expiry date. When that date hits, the contract settles. The trade is done. It's got a defined endpoint, a deadline.
Okay, got it. So it's locked in time, it expires.
Exactly. Now, crypto kind of flipped this on its head. They invented the perpetual contract. Fundamentally, it's still a futures contract, a bet on future price. But the key difference, no expiration date, none. You can hold a leveraged bet, your position, on Bitcoin or Ethereum, well, potentially forever. You don't have to worry about it expiring and having to roll it over or deal with settlement dates.
Huh. Okay, so if I put up, say, $100 and I buy a Bitcoin perp, I don't actually own any Bitcoin. I'm just making a bet 24/7 on whether the price goes up or down, and I don't have to worry about storing the actual coins myself.
Precisely. That's the core function. You're speculating purely on price movement.
Yeah.
You can go long if you think the price will rise or short if you think it'll fall. And yeah, this ability to trade the price without actually holding the underlying asset, that's a huge part of the appeal. It simplifies things massively. That simplicity, plus the fact it trades nonstop, 24/7, 365, is why it's just completely taken over crypto trading. It's the dominant product, hands down.
And it's not just about being simple or always open. It's about the leverage, right? The almost terrifying power of leverage. Let's use that example you mentioned earlier because it really drives home how you can make or lose a lot really fast.
Oh, the leverage is absolutely the hook. It's the addictive part. So imagine you have $1,000 of your own money, your capital, and you decide to use, let's say, a fairly modest 10x leverage. Suddenly, that $1,000 controls a position worth $10,000 in Bitcoin. Now, if Bitcoin's price goes up by just 10%, say, from $60,000 to $66,000, your $10,000 position has gained $1,000. That $1,000 gain, that just doubled your initial $1,000 stake. Boom, 100% return on your capital from a 10% market move.
Right, okay. I see the appeal. That's why people are drawn to it. But hold on. If I can double my money that easily, where's the catch? What's the risk? Does the platform, the exchange, cover me if the price goes down 10%?
That's the million-dollar question, isn't it? And the answer is a hard no. The platform takes zero risk here. It's all on you. The risk is immediate and it's total. If Bitcoin drops just 10% instead of rising, your $10,000 position loses $1,000. But wait, $1,000 was all the actual money, the margin you put up to open that position. So poof, your entire stake is gone. That's called liquidation. Wiped out. The exchanges have these sophisticated liquidation engines that automatically grab your collateral and close your trade the instant your margin runs out. They make sure they don't lose money.
Wow. Okay, that sounds intense. Less like careful investing and more like, yeah, financial Russian roulette at high speed. It's kind of hard to believe people regularly use high leverage, but the numbers show they absolutely do.
They do. And this brings us to a really crucial mechanism that actually keeps this whole potentially chaotic system somewhat anchored to reality. It's called the funding rate. See, because these contracts never expire, they're perpetual, the market needs some way to make sure the price of the perpetual contract stays roughly in line with the actual real-time spot price of Bitcoin or whatever the underlying asset is.
Okay, walk us through that funding rate, because this sounds like a key piece of the puzzle, how the money flows between traders.
It is. So the funding rate is basically a small payment. It's usually calculated and exchanged between traders every, say, 8 hours, sometimes more often. And it goes between the longers, the people betting the price goes up, and the shorts, those betting it goes down. It acts like a gravity mechanism. If the price of the Bitcoin perpetual future starts trading higher than the actual spot price of Bitcoin, it usually means there's more demand from buyers, more people are going long. So to pull it back down, the system makes those long traders pay a small fee to the short traders.
Huh. So the people who are bullish are literally paying the people who are bearish to sort of balance things out.
Exactly right. It does two things. One, it makes being long slightly more expensive, which might discourage a few people from piling in. Two, it makes being short more attractive because you get paid. So it incentivizes more people to come in and short, which pushes the perpetual price back down towards the spot price.
Right.
And obviously the reverse happens. If the perpetual price dips below the spot price, then the shorts have to pay the longs. It's this constant dynamic push and pull happening 24/7, keeping things relatively tethered. It matches the speed of crypto.
Okay, that makes sense. So given this crazy leverage, the risk of total liquidation, this funding rate mechanism, why is this the product that dominates crypto? You said 75% of all volume. Why?
Yeah, it really comes down to, I think, four main things that just perfectly fit the crypto trading mindset. First, like we said, is access and velocity. No market close, ever. Volatility spikes at 3 a.m. on a Sunday. The Pope market's wide open, ready for you.
Right. And second is that incredible capital efficiency from leverage. We talked about 10x, but some platforms, especially the big centralized ones, advertise leverage up to, what, 100x? 125x even?
It's insane. Think about 125x. Someone with just $10,000 could, in theory, control a position worth $1.25 million. Now, that level of efficiency is magnetic. It attracts huge professional trading firms because they can maximize their returns on capital. And it attracts smaller retail traders dreaming of that massive lottery ticket win.
Okay, and third, you mentioned this earlier, the ability to profit both ways, dual profitability.
Yeah, this is huge. In the regular spot market, you buy Bitcoin, you only make money if the price goes up. That's it. With perps, you can short. You can bet on the price going down. So if the market crashes, you can actually make a lot of money. This means every market condition, bull run, bear market, sideways chop becomes a trading opportunity. It just dramatically increases the potential activity, the velocity of money.
And the last factor, it just fits the culture.
Yeah, pretty much. You know, a lot of the crypto trading community, especially the really active segment, sometimes called degens, they thrive on momentum, quick swings, high risk, high reward. They want fast action, immediate results. Perps are tailor-made for that kind of high-velocity speculative mindset. It's the main arena for that crowd.
So this absolute dominance of perpetual futures, it wasn't born out of some grassroots DeFi movement, right? This empire was built by the big centralized exchanges, the CEXs.
That's exactly right. And the history matters here. The story really kicks off around 2016 with BitMex. Its founder, Arthur Hayes, is widely credited with pioneering the perpetual swap contract. He kind of set the stage, the culture of high leverage. But while BitMex invented it, it was really the next wave of giants like Binance, Bybit, OKX that took that product and scaled it into this massive global operation. They built the empire with incredible efficiency and deep liquidity.
And the sheer scale of this CEX empire is hard to wrap your head around. Our sources say, together, these platforms process something like $57 trillion with a T in leverage trades every single year.
It's a staggering number, absolutely staggering. And that's why even now, they still control well over 90% of the entire perpetual futures market. They are the incumbents.
And they hold that dominant position because they offer real advantages, right? It's not just inertia.
Definitely. They provide things that traders, especially big institutions, really need, like institutional-grade liquidity. That means if you place a huge order, even with leverage, it gets filled instantly at a good price. That's critical when you're trading fast. They also offer, slick, polished user interfaces, apps that are easy to use, 247 customer support desks. And importantly, they maintain these huge insurance funds.
Mm.
These are pools of money set aside to cover losses if something truly catastrophic happens, like a market manipulation event or a system failure on their end. They project stability, like traditional finance.
Okay, so if they're so slick, so liquid, handle so much volume, and have insurance, why did anyone start looking for an alternative? What was the spark for this Defy rebellion? Where did the CEXs fall short?
It really boils down to one fundamental issue: the trust problem and the counterparty risk that comes with it. See, to trade on Binance or Bybit or any CEX, you have to send them your money. You deposit your collateral onto their platform, into their control. You are giving up custody. You have to implicitly trust that exchange, not to mess up, not to trade against you, not to freeze your funds, or, worst case, not to get hacked to go bankrupt.
And recent history gave traders plenty of reasons to question that trust, didn't it?
Oh, absolutely. The sources we looked at point back to the chaos during the big market crashes, like in 2020. Multiple major exchanges suddenly faced liquidity issues. What do? They froze withdrawals. They halted trading on certain volatile pairs. They went down for unexpected maintenance right when volatility was peaking. Imagine having a massive leveraged position blowing up against you, and you literally can't log in to manage it or close it. That happened. Plus, you had the BitMex situation, the pioneers themselves facing criminal charges from the U.S. government for violating anti-money laundering laws. All these things created this deep-seated fear among serious traders. What happens if the platform I rely on suddenly shuts down or gets seized or just decides to protect itself instead of me?
Yeah, that mix of fear, frustration, maybe some anger.
Yeah.
It created the perfect environment for people to start demanding something different.
And it happened right around the time of DeFi summer in 2020. That whole movement was showing the world that financial services, like just swapping one token for another on Uniswap, could actually run transparently on public blockchains. No central company needed. That proved that self-custody, holding your own keys, was actually viable, even for complex financial stuff.
So the demand wasn't just some philosophical preference for decentralization. For these high-stakes traders, it became intensely practical. They wanted guarantees the CEXs just couldn't or wouldn't provide.
Exactly. They basically wanted three core things. One, transparency. They wanted to be able to look at the blockchain and verify every single trade, every single liquidation, to make sure the exchange wasn't playing games or manipulating prices behind the scenes. Two, self-custody. They wanted their collateral, their margin, to stay in their own crypto wallet under their control, secured by their private keys, not sitting on an exchange's balance sheet. And three, censorship resistance. They wanted an absolute guarantee that no company, no regulator, no government could just freeze their account or halt their trading in the middle of a volatile market event. The huge challenge, though, was technical. How on earth do you build a system that's fast enough for the insane speed of perp trading, but also has the security and decentralization guarantees of a public blockchain like Ethereum, which was notoriously slow and expensive back then? That was the big hurdle.
Right, because that was the initial problem, wasn't it? Trying to build this super fast trading engine on something like Ethereum mainnet, it just wasn't feasible. Too slow, gas fees were way too high.
Totally infeasible for the kind of order frequency you need in perp markets. That's why dYdX was such a big deal when it really hit its stride in 2021. It was founded by an ex-Coinbase engineer, Antonio Juliano, and they had a clever architectural solution. They recognized you couldn't do everything directly on Ethereum Layer 1. So their breakthrough was using a specialized Layer 2 scaling solution, specifically one called StarkX, developed by Starkware.
Okay, layer 2 scaling. For listeners not deep in the tech weeds, what was StarkX actually doing to make things faster and cheaper?
So instead of trying to cram every single order placement, cancellation, and trade onto the main, slow, expensive Ethereum blockchain, StarkX did something different. It basically took huge batches of these trading activities off-chain. It processed them super fast in its own environment. Then it used some very advanced cryptography, these things called validity proofs or Stark proofs, to mathematically prove that all those off-chain transactions were done correctly according to the rules. Only then would it post a single compressed proof back to the main Ethereum chain for settlement. It's like processing thousands of transactions privately, then just showing Ethereum the verified receipt. This hybrid approach gave them incredible performance, almost CEX-like speeds, sub-second trade execution. They had a really professional user interface, too. And crucially, because the off-chain processing was so efficient, they could cover the final Ethereum gas costs, meaning traders paid zero gas fees. That was huge.
And it worked, right? They got traction fast, attracted big institutional market makers like Wintermute. Their volumes exploded.
Oh yeah, the success was almost immediate. At their peak, dYdX was doing billions in daily volume, sometimes rivaling the volume of mid-tier centralized exchanges. It really felt like the future of DeFi trading had arrived.
Yeah.
But, and this will be dumb, dYdX's journey became this fascinating, maybe cautionary tale about the tension between wanting that institutional polish and staying true to the core DeFi ideals. They made some significant missteps that really alienated parts of the community. The first big one, really infamous, was in late 2022, the liveness check controversy.
Ah, yes, I remember this. This was when they required new users to do a webcam facial scan, a biometric check, just to get a small $25 sign-up bonus.
That was it. Now, their stated reason was understandable. They wanted to prevent people from creating hundreds of fake accounts just to farm the bonus money. A Sybil attack. But the optics, catastrophic. The core DeFi community values privacy and pseudonymity highly. Being asked to provide biometric data, even for a small bonus, felt like a complete betrayal, a traitor move, as some called it. It looked like they were caving to surveillance, adopting the practices of the old system they were supposed to replace, sacrificing core values for $25.
Ouch. And it wasn't just the cultural missteps, was it? The way their token worked also caused friction, especially with the more active retail Degen traders.
Right, the tokenomics. Their native token, dYdX, was primarily a governance token. Holding it gave you voting rights on the future of the protocol. But the distribution was heavily weighted towards early investors and venture capital firms. This created what the sources call a vesting overhang. Basically, everyone knew these big VC funds had huge amounts of tokens scheduled to unlock over time vesting. And the fear was they'd just dump them on the market as soon as they could, constantly suppressing the price. So the active traders, the people generating all the fees and volume for the platform, they didn't feel like they were really benefiting. They wanted a chance at wealth creation from using the platform, maybe a big airdrop like we saw later. Instead, they got a governance token, potentially weighed down by VC selling pressure. It didn't align incentives well for that user base.
And all this kind of culminated in their biggest gamble, which then turned into a major failure in 2024. The move to their own blockchain and the chain halt.
Yeah, they decided that even the layer 2 wasn't enough. They wanted ultimate control and optimization. So they took a huge leap and migrated the entire dYdX platform onto its very own custom-built blockchain using the Cosmos SDK. This was dYdX v4. Becoming a sovereign chain meant they controlled everything: block times, transaction fees, the validators running the network, how upgrades happened. The goal was pure performance, tailored specifically for perp trading. But during a planned network upgrade, something went wrong. Seriously wrong. The chain just stopped. It halted for hours. Billions of dollars in open leverage positions were frozen. People couldn't trade, couldn't manage risk, couldn't do anything.
That is literally the nightmare scenario for anyone trading with leverage. The one guarantee DeFi is supposed to offer, unstoppable code execution, just vanished.
Exactly. It completely shattered trust. It exposed the potential fragility of relying on a relatively small, coordinated group of validators to perfectly execute complex software upgrades. The whole point of DeFi is that the code is law and runs predictably. When the chain itself halts due to human error or coordination failure around an upgrade, well, it raises fundamental questions about how decentralized it really is. That kind of trust, once broken so spectacularly, is incredibly hard to win back.
So while dYdX was grappling with these big architectural choices and, frankly, community issues, another project came along with a totally different approach: GMX.
Right. GMX, which first launched on Arbitrum, another layer 2, basically looked at the dYdX model and said, let's try something completely different. They threw out the traditional order book system entirely. Instead, they pioneered this really elegant, simple concept. Traders don't trade against other traders or market makers. They trade directly against a big shared basket of assets called the GLP liquidity pool.
Okay, GLP pool. How does that work? If there's no order book matching buyers and sellers, who takes the other side of my trade? And how is the risk managed?
So the GLP pool is made up of a mix of solid crypto assets, think Ether, Bitcoin, maybe some stable coins, all contributed by users who want to be liquidity providers, or LPs. When you, as a trader on GMX, open a long position on ETH, you're essentially betting against the pool. The pool is your counterparty. This creates a very clear zero-sum game. If you make money on your trade, the value comes out of the GLP pool, meaning the LPs effectively lose a bit. If you lose your trade, get liquidated, or pay funding fees, that value goes into the GLP pool, benefiting the LPs. They earn yield from traders' losses and fees.
That sounds incredibly risky for the LPs, the people putting assets into the GLP pool. Why would anyone provide liquidity if they're just betting against potentially savvy traders?
That's where the incentive design was really clever. GMX made it potentially very profitable to be an LP and take on that risk. They set it up so that holders of the GMX governance token got 30% of all the fees generated by the platform trading fees, liquidation fees, swap fees, all of it. But the GLP providers, the LPs, actually taking the counterparty risk, they received a whopping 70% of all those platform fees. This created a system where providing liquidity could generate significant real-time yield, paid out in assets like ETH. It wasn't just about a governance token price going up, it was about earning consistent cash flow. That was a very different value proposition than dYdX.
A very different appeal, yeah. Attracting people looking for yield, willing to take calculated risk, and GMX really proved itself during the brutal crypto bear market of 2022-2023, didn't it? That was its trial by fire.
Absolutely. That period saw giants like FTX collapse. Major CEXs were laying off huge chunks of their staff. It was rough. GMX, though, it thrived. Its model worked beautifully in down markets, too. Why? Because bear markets mean more people shorting, more volatility, often more liquidations. All of that activity generated fees, and 70% of those fees flowed directly to the GLP holders. It showed that a well-designed DeFi protocol with properly aligned incentives couldn't just survive market stress, it could actually benefit from it without needing VC bailouts or corporate safety nets. It was a huge validation for that model.
Okay, so by late 2023, we had dYdX showing the potential, but also the pitfalls of Layer 2s and governance tokens, and GMX proving the power of a novel liquidity model. The stage was set for the next evolution. Platforms aiming for CEX-level performance with true DeFi principles. And that's where Hyperliquid enters the scene.
Exactly. Hyperliquid seemed to learn lessons from both predecessors. They looked at the speed limitations that even Layer 2s like dYdX eventually hit, and they probably saw the potential scaling issues or impermanent loss risks in the GMX model. So they took the most ambitious path possible. They didn't build on Ethereum or a Layer 2 or even a general-purpose Layer 1 like Solana. They built their own, completely custom Layer 1 blockchain from the ground up, designed for one thing and one thing only, running a high-performance Perpetual Futures dAX. They called it Hypercore.
And the performance numbers they claimed were just astronomical, weren't they? Something like 200,000 transactions per second. How does that even compare to other chains?
It's almost hard to compare because it's so specialized. A general-purpose chain like Ethereum might do 15 TPS, maybe a bit more. High-performance chains like Solana aim for tens of thousands. Hyperliquid achieving 200,000 TPS or even claiming the capacity for it comes from extreme optimization. Hypercore basically gives up the ability to run all sorts of different decentralized applications. It doesn't try to be a world computer. Its entire architecture is focused on one task: matching orders for perpetual futures incredibly quickly. It's built to handle the fire hose of order placements, modifications, and cancellations that you need for a smooth, high-frequency trading experience.
And crucially, alongside that speed, they delivered on the core DeFi promises people wanted after the dYdX stumbles, right? Transparency and cost.
Absolutely. Full transparency. Every single order, every match trade, every liquidation, it all happens verifiably on their public Hypercore chain. No hidden matchmaking engine. You can see everything. And, like the successful Layer 2s, they managed the costs so that traders experience zero gas fees. You got the speed and feel of a CEX, but with the transparency and verifiability of DeFi. That was the holy grail. But honestly, the tech was only half the story. Their go-to-market strategy, their cultural positioning was just genius, especially the point system. From day one, Hyperliquid cultivated this image. They were anonymous founders, supposedly anti-VC kind of cypherpunk ethos. They explicitly rejected taking money from big venture capital firms early on, and they launched with this massive gamified rewards program. Basically, the more you traded, the more liquidity you provided, the more people you refer, the more points you earned. Everyone knew these points would eventually convert into a huge airdrop of their future token.
They tapped right into what the dYdX community felt it missed out on, that chance for a massive wealth event just by being an active early user.
Precisely. They understood the degen psychology perfectly, and the payoff was enormous. The eventual airdrop distributed something like $1.2 billion worth of tokens to around 90,000 users. That didn't just buy loyalty, it cemented their position. It injected huge amounts of capital back into their most active users, validating the whole built by the community for the community narrative.
Okay.
Unsurprisingly, Hyperliquid's volume just exploded. Daily volumes quickly shot past $1 billion, and on peak days, they were regularly hitting $7 billion, even $10 billion. Analysts started calling it the best Perp to X, hands down.
But success breeds competition, especially in crypto. You build something great, someone else is going to try and copy it or beat it. And in late 2024, a major challenger emerged: Aster. And this one came with serious backing.
Yeah, Aster wasn't some small startup. It launched with a bang. And the big headline was that it was backed by YZI Labs, the investment fund associated with CZ, the founder of Binance. This wasn't subtle. It was positioned explicitly as a direct strategic competitor designed to take on Hyperliquid. This was a well-funded, highly aggressive play for market share right from the start.
And they didn't waste time trying to be radically different, did they? They basically took the Hyperliquid playbook and ran with it.
They absolutely did. They saw what worked.
Yeah.
So Aster launched its own super aggressive points and incentive program, clearly designed to mimic Hyperliquid's success. They ended up distributing over $704 million in their own airdrops, trying to lure users and volume away. Their whole focus seemed to be less on ideological purity and more on just raw, pragmatic performance and rapid scaling. They leveraged existing faster infrastructure, like the Binance Smart Chain, BSC, to get access to a huge existing user base very quickly, even if BSC is generally considered less decentralized than a custom layer 1 like Hypercore.
And that sheer aggression, powered by that funding, it worked in terms of volume, didn't it? Aster hit some truly mind-boggling numbers.
Astonishing numbers. At one point, Aster reported a peak daily trading volume of $60 billion. That's a figure that was just completely unheard of for a decentralized exchange before. Yeah. It was CEX-level volume. But that scale, and especially the source of its backing and some of its other token holders, came with significant baggage, particularly for the core DeFi crowd. While Hyperliquid was playing up its anonymous anti-establishment roots.
And for the crypto natives, the Desians who value decentralization and resistance to the old financial system, seeing those kinds of names involved immediately rings alarm bells, right?
Big time. It creates this immediate tension and suspicion. The fear is that these large traditional finance holders with their massive token allocations will eventually use their influence to push the platform towards more centralized control. Maybe stricter KYC/AML compliance, or lobby regulators in ways that benefit them, but undermine the core DeFi principles of permissionless access and censorship resistance. It felt like a potential corporate takeover from within.
So this rivalry, Hyperliquid versus Aster, it just escalated into this crazy incentives arms race, didn't it?
Totally. They were constantly trying to outdo each other with reward multipliers, bonus points, new ways to earn tokens. It forced incredibly rapid innovation on both sides just to keep users engaged. And it led to this weird dynamic called farming both sides. You had traders who didn't necessarily have a strong opinion on the market direction, but they'd split their capital, open longs on Hyperliquid and shorts on Aster or vice versa simultaneously, just to rack up trading volume and points on both platforms to maximize their potential airdrop rewards. So sometimes the trading volume figures became a bit detached from actual real market activity or conviction. It was volume generated purely by chasing incentives.
So the battle lines were drawn. Hyperliquid, kind of the purest ideology-driven choice with its own tech stack. Aster, the pragmatic, performance-at-all-cost challenger, using existing infrastructure and big money backing, but with those TradFi ties causing unease. It really became a fight over the soul of decentralized perps. Okay, so you have this intense competition, these different philosophies, billions flowing through these systems every day, all the theoretical arguments about which approach is better, faster, safer, more trustworthy. It all came crashing into reality on one specific day in October 2025. This became the ultimate real-world stress test for the entire $1 trillion perpetual futures market, centralized and decentralized.
Yeah, this event was absolutely brutal, and it started with a geopolitical shockwave. The specific trigger, according to our sources, was an announcement from Donald Trump. He publicly declared an intent to impose a massive 100% tariff on all imports of Chinese rare earth minerals. Now, rare earths are critical for everything from smartphones to electric vehicles to advanced military tech. A 100% tariff is basically a trade war declaration in that sector. It sent immediate panic through global markets.
And the crypto market, being always on, hyper-leveraged, and globally connected, it reacted instantly and violently, like pouring gasoline on a fire.
Exactly. It was like a chain reaction. Within just a few hours, the market saw catastrophic cascading liquidations. The numbers are staggering. Over $19 billion in leveraged positions were just vaporized worldwide. That breaks down to roughly $16 billion in long positions wiped out, and even about $2 billion in short positions got liquidated in the chaos. Total carnage. This was the moment of truth. Could the infrastructure, CEX and DX, actually handle this level of extreme stress?
And this is where the established giants, the centralized titans, Binance, Bybit, OKX, the ones handling $57 trillion a year, this is where they really stumbled badly.
They buckled. We saw all the classic problems associated with centralized systems under duress. Multiple exchanges simply halted, trading all together on the most volatile pairs, like Bitcoin and Ethereum perps. They did this presumably to protect their own solvency, their own insurance funds. Users reported widespread failures with stop-loss orders. These are supposed to be your safety net in leverage trading, automatically closing your position if the price hits a certain point. But people were saying their stops either didn't trigger at all or they executed with horrific slippage, meaning they closed out way, way lower than the price they set, leading to much bigger losses than expected.
For someone trading with 50x or 100x leverage, a failed stop loss isn't just an inconvenience, it's potentially ruinous. It means losing vastly more than you'd planned or could afford.
Absolutely devastating. The CEXs essentially prioritized their own operational stability and balance sheets over ensuring their users could execute trades or manage risk effectively during the peak crisis. And adding fuel to the fire, Jeff Yan, the founder of Hyperliquid, very publicly accused Binance, the biggest CEX, of manipulating the data they were releasing. He claimed they were only reporting 1 liquidation per second for each trading pair, which he argued was technically impossible given the scale of the crash and likely masked the true extent of the chaos and failures happening inside Binance's own systems.
So basically, accusing them of hiding the truth about how badly their systems were performing to maintain a public image of control.
That was the implication. It went right back to that core trust problem. CEXs might be fast in normal times, but under maximum stress, the accusation was they could and would obfuscate data and protect themselves first.
Okay, now contrast that CEX meltdown with what happened on the decentralized side, particularly with Hyperliquid. This is where the architectural choices really paid off, wasn't it?
This was the moment of validation for the DX proponents. Hyperliquid, built on its own dedicated chain, stayed fully operational throughout the entire flash crash. No halts, no pauses. Despite the absolute mayhem in the markets, every single order submitted, every trade matched, and crucially, every necessary liquidation. And remember, over $1 billion in positions were liquidated just on Hyperliquid that day. Every single one was processed exactly as programmed. It was all transparently recorded on the Hypercore blockchain in real time, visible to anyone.
Why didn't they freeze up or halt trading like the CEXs did?
Because there was no one to make that decision. Hyperliquid's matching engine and liquidation system run as immutable smart contracts. It's code executing on a blockchain. There's no CEO, no risk management committee that can step in and say, okay, things are too crazy, let's pause everything to save the company. The code just keeps running according to its predefined rules, processing transactions block by block. The Hypercore chain didn't care about the market chaos. It just kept producing blocks and executing the logic. It proved that, under extreme stress, the decentralized code-driven system was actually more reliable, more resilient than the centrally managed corporate systems. Its trustless nature wasn't just a philosophy. It had immense practical value when everything hit the fan.
In the aftermath of the crash, beyond just system performance, it also unearthed some really troubling signs of potential market manipulation or insider knowledge, right?
Yet the on-chain analysts, the chain detectives, went to work immediately scrutinizing the blockchain data leading up to the crash. And they found some very suspicious patterns. Multiple large whale wallets were observed opening massive short positions, betting on a price drop, just minutes before Trump's tariff announcement actually became public knowledge. The timing was just too perfect. It strongly suggested that a handful of traders somehow got advance warning of this major geopolitical event, allowing them to position themselves perfectly to profit massively from the ensuing chaos, making tens of millions in hours.
That goes beyond just good trading. That smells like insider information. Did anyone call for investigations?
Oh yeah. Prominent figures like Chris Marszalek, the CEO of Crypto.com, publicly called for investigations. Not just into the potential leak of the geopolitical news, but also questioning whether some CEXs might have manipulated their own price oracles. The data feeds they used to determine asset prices during the crash, potentially contributing to the liquidation cascades, and how these whales seem to know exactly when to strike. So the flash crash wasn't just a market event, it became this defining moment. It starkly contrasted the behavior of CEXs defaulting to opacity, prioritizing self-preservation, potentially manipulating data with DEXs like Hyperliquid, which, governed purely by code, just kept executing transparently and flawlessly, even under unimaginable stress.
#hackhack.fun.
So if we stand back and look at that October 2025 flash crash as the ultimate test, and we think about what it really means, it brings us right back to that fundamental question underlying this whole trillion-dollar war, doesn't it? Who should control the rails of our financial system? Who do you want running the critical infrastructure when everything is on the line? That really is the core question for you, the listener, to wrestle with now. We've seen the two models tested under fire. On one hand, you have the established corporations, the CEXs. They have huge resources, slick interfaces, customer support. But they're ultimately accountable to shareholders, regulators, and as we saw, prone to freezing up, hiding data, and protecting themselves when things get really bad. You have to trust them. On the other hand, you have these open protocols, the DXs. They aim to be governed by transparent code, verifiable by anyone. Every action is on a public ledger. But they can be complex, maybe less user-friendly for beginners, and if the code has a bug or if you make a mistake, there's often no central authority to appeal to. You have to trust the code.
And that crash seemed to provide a pretty clear answer, at least in terms of reliability under duress. The code proved more trustworthy, more dependable than the corporations.
It certainly made a powerful case. And I think this fundamentally shifts the future landscape. We're probably not going to see CEXs disappear overnight. We'll likely have coexistence for a while. Maybe the market splits. Casual users who value ease of use and having a support line might stick with CEXs. But the serious traders, the institutions, the high-volume players who absolutely need guaranteed execution, self-custody, and transparency, they're likely going to migrate, maybe overwhelmingly, to the proven decentralized platforms.
And the CEXs will have to respond, won't they? They can't just ignore this. We might see a push towards hybrid dominance.
Just exactly. The smarter CEXs will likely try to integrate more transparency features, maybe adopt some verifiable on-chain components to try and rebuild trust. Or we could see entirely new platforms emerge that try to blend the best of both worlds' CEX-level performance and user experience, but with DEX-like transparency and self-custody options. But there's also a more radical possibility: full decentralization victory. If the performance gap keeps closing, if DXs continue to improve usability, and if regulatory pressure on CEXs keeps mounting, maybe users just increasingly decide the trustless, proven resilience of DXs is simply the better choice across the board. Why take the counterparty risk if you don't have to, especially when the code works better under pressure?
It's fascinating. The battle for that $1 trillion in annual trading volume is definitely not over. But October 2025 drew a very clear line in the sand. It showed everyone that in finance, especially high-stakes, high-leverage finance, the single most important competitive advantage isn't just speed or features, it's reliability under extreme stress. We saw what happens when that reliability fails.
Which really leaves you, the listener, with a final thought to chew on. If we just witnessed a scenario where computer code running on a decentralized network proved demonstrably more reliable, more trustworthy than massive, regulated financial corporations during a full-blown market meltdown, what does that fundamental insight tell us about the kind of financial system we should be building for the future? And maybe more importantly, who do we actually want holding the keys?